The comparison between mutual funds and ETFs in 2025 is key for investment choices. It can impact long-term wealth, potentially saving significant amounts. Mutual funds still hold over $16 trillion in global assets, while ETF assets reached $14.6 trillion, growing 27% in 2024. ETFs deliver 1.05% higher after-tax returns annually than comparable mutual funds, equaling an extra $329,311 over 30 years. This analysis explores differences, performance, costs, taxes, behaviors, management styles, market innovations, and recommendations for investors. Mutual funds, MFs, are large investment pools managed by professionals. Pricing: MFs are priced at market close, NAV, and cannot be traded during hours. Management: they can be actively managed or passively track an index. Minimums: initial investments range from $1,000 to $3,000 in the US. Features: automatic dividend reinvestment and systematic investment plans, SIPs, are offered. Transparency: holdings might only be disclosed quarterly, potentially changing significantly. Exchange-traded funds, ETFs, are investor money pools trading on exchanges, resembling stocks. Pricing and AMP trading: you can trade ETFs throughout market hours, with prices changing based on buyer-seller dynamics. Management: most ETFs are passively managed, though active ETFs are growing rapidly. Minimums: there are typically no minimums, you can buy one share. Features: ETFs include advanced trading options and brokers offering automatic dividend reinvestment similar to MFs. Transparency: holdings are fully transparent, published daily. While distinctions blur, core differences remain. ETF structure offers better tax efficiency through in-kind redemptions, while mutual funds allow certain automatic investments. These fundamental differences affect taxes, costs, and investment experiences. Cost comparison: investment costs are arguably the most important factor determining long-term wealth-building success. Small annual fee differences compound into enormous wealth variations over investing lifetimes. A seemingly modest 1% annual fee difference can cost over $250,000 over 30 years. Mutual fund costs, expense ratios. The most obvious annual fee, ranging from 0.5% to 2.5% for actively managed equity funds, Indian equity MFs average 1.8%, 2.2%, US funds 0.8%, 1.2%. Index mutual funds cost much less, 0.05%, 0.2%. Load fees. Sales charges: front-end loads of 1%, 5.75% reduce initial investments, back-end loads of 0.25%, 4% discourage exits. No-load funds are becoming common, but many investors still pay these unnecessary charges. Hidden costs. Not appearing in expense ratios, these include bid-ask spreads, market impact costs, and brokerage commissions when fund managers trade securities, estimated to add 0.1%, 0.5% annually. 12b-1 marketing fees, up to 1% annually, these pay for fund distribution and advertising, effectively charging investors to market to others. ETF cost structures, expense ratios, much cleaner, ranging from 0.03% for broad market ETFs to 0.75% for specialized sector ETFs, averages are 0.14% for equity ETFs and 0.20% for bond ETFs. For example, Vanguard Total Stock Market ETF charges 0.03%, and SPDRS and AMP P500 ETF charges 0.09%. Trading costs. Brokerage commissions are often zero at major brokers for ETF trades, plus bid-ask spreads, 0.01%, 0.5% depending on liquidity. Crucially, you only pay trading costs when you actually trade. No load or 12b-1 fees. ETFs have no load fees or 12b-1 marketing fees. Dramatic wealth differences from fees. A $100,000 initial investment over 30 years with 7% annual market returns, comparing a high-cost active mutual fund, 1.5% expense ratio, to a low-cost ETF, 0.05% expense ratio, shows a $329,311 additional wealth favoring the low-cost ETF. The high-cost fund pays nearly $200,000 in fees, while the low-cost ETF pays only $1,775. Tax implications. Tax efficiency can potentially impact long-term wealth more than fees, yet 95% of investors ignore it. ETFs provide over 1% annual after-tax return advantages for wealth building outside retirement accounts. Mutual fund tax problems. MFs create three types of tax obligations: dividend taxes, capital gains taxes when you sell shares, and capital gains taxes on fund distributions even when you haven't sold anything. This third category is particularly problematic. When fund managers sell stocks for a profit, they must distribute those capital gains to all current shareholders by law, regardless of when they bought in. This can lead to investors paying significant taxes on gains that occurred before their investment or even on funds that lost money during their ownership. You cannot opt out, defer, or control these distributions. ETF tax solutions. ETFs solve tax problems through in-kind redemptions. When large institutional investors redeem ETF shares, they receive actual stocks, specifically those with the lowest cost basis or biggest unrealized gains, instead of cash. This process transfers tax burdens to redeeming institutions, often tax-exempt, essentially making taxes disappear for individual shareholders. Individual ETF shareholders never receive taxable distributions through this process, and only pay capital gains taxes when they personally decide to sell shares. Academic research consistently shows ETFs providing approximately 1.05% higher after-tax returns annually compared to similar mutual funds. For a $100,000 investment over 30 years at 7% returns, the ETF's tax advantage could lead to an extra $112,599 from tax efficiency alone. Global variations exist. In India, equity ETFs and mutual funds face identical tax rates, with ETF advantages coming from fewer taxable distributions rather than different rates. However, US and European markets show more pronounced ETF tax advantages, as mutual funds often distribute 3–5% of value as taxable gains annually, while equivalent ETFs distribute zero. Performance and management, active versus passive, 2025 performance data. Indian equity mutual funds delivered impressive 17.67% average returns in the first half of 2025, with some mid-cap and small-cap funds exceeding 30%. However, SPIVA data shows 74% of actively managed mid- and small-cap funds underperformed benchmarks in 2023, and 52% of large-cap funds failed to beat benchmarks. Global ETF performance shows growth and solid returns, with inflows exceeding $0.9 trillion by mid-2025, a 25% increase over 2024. Broad market ETFs performed solidly across global markets, providing performance predictability. Most broad market ETFs track within 0.05% of underlying indices. Active versus passive debate. Passive investing with low-cost ETFs often outperforms active managers after fees. 85.7% of large-cap mutual funds underperform after fees, worsening over time. Survivorship bias obscures underperformance rates, potentially reaching 90–95% when all funds are considered. Consistent outperformance is rare among active funds. Active management may succeed in emerging markets, fixed income, and alternative strategies, but ETFs often provide better tax efficiency and lower costs. Factor-based investing offers a balanced approach, emphasizing characteristics like value and momentum, typically with lower ETF fees. Behavioral considerations. Investment behavior overrides strategy optimization. ETFs offer flexibility, but this can lead to emotional trading, harming long-term returns. Mutual funds automate investment behaviors, enhancing systematic investment outcomes. Recent innovations in ETFs allow full automation, with platforms like robo-advisors offering recurring transfers and rebalancing. 2025 market innovations. Active ETFs are gaining traction, growing annually by 20–30% due to new SEC regulations. Cryptocurrency ETFs are emerging, attracting younger investors and providing regulated access to digital assets. ESG ETFs now reflect sophisticated strategies focusing on climate, social impact, and governance. Robo-advisors integrate AI for enhanced portfolio management, emphasizing ETFs for tax efficiency. Fee disclosure and fiduciary standards are improving, benefiting ETF transparency and costs. Recommendations for investors. Under $10,000, low-cost index mutual funds help build habits through automatic investing. $10,000 to $100,000, transition to ETF portfolios for tax benefits, using a core satellite approach. Over $100,000, use 80% in ETFs and 20% in selective active exposure for optimal strategies. Hands-off, choose target date mutual funds or ETF-based robo-advisors for diversified portfolios. Universal principles for wealth building. Keep costs low as fees hinder compounding. Start early and invest consistently. Time beats timing. Diversify globally and keep strategies simple. Adopt an investment strategy you can maintain through market changes. Acknowledging your behavioral tendencies is essential for success. Thanks for watching and remember to like and subscribe to stay updated.